For that, we bring in Jeff Mills, Managing Director and Co-Chief Investment Strategist with PNC Financial Services Group, and Matt Roddy, Vice President and Portfolio Manager with Rockland Trust. Jeff, I'm going to start with you. What do you think? We're having a little bit of a rally on our hands, at least when you look at the Dow Jones Industrial Average. We've heard from Larry Kudlow, a long interview here on CNBC yesterday. Peter Navarro also spoke with us at length earlier this morning. Do you think the markets are a little comforted? Have we quelled some fears about a potential trade war after hearing from these two?
Yeah, look, I think so, and we view it as largely a positive. And if you look at the way the market's performing today, if you look at tech, if you look at industrials, companies like Boeing leading the market higher, I think the market's looking to Larry Kudlow's appointment as he is now going to step into the White House as the free trade voice. And I also think that you can take some positive signals from the fact that Trump is actually willing to bring someone into the fold who has clearly disagreed with some of his trade policies very publicly. If you want to be cynical about it, you can say Trump does have a lot of legal leeway in terms of how he deals with trade policy, but really we think Kudlow coming in is going to be a positive, and the market appears to be reacting to it that way as well.
Matt, earlier on in the program, we talked a little bit about the uncertainty in the markets just because of all of the uncertainty that is still continuing in Washington. We have a Fed that maybe we're expecting 3 to 4 rate hikes, but inflation could be coming in, creeping up. What are your thoughts about all of the cross currents in the markets? Are you feeling as if this rally will continue, or are you waiting for us to step back and sort of retest those February lows?
Yeah, well, the market has gone, as we know, started up on a turbo shot from the tax cuts and then got a dose of some cold water, more like the ice bucket challenge, I'd say, with the inflation numbers that came out in January. But the Fed, is taking away some of the seats at for the musical chairs game here as they raise rates a little bit. And inflation, they know it's there. They've known it's there before it even showed up. They were raising rates last year in anticipation of this. So it really wasn't a surprise to them, but it was to the markets. I would say the market has not really done much this year if you really net out all the ups and downs. And earnings, meanwhile, have come up dramatically since the end of the year. So the market's gotten cheaper while we've been sitting through these first couple months. And guess what? 2 weeks from now, the earnings season begins to roll out in earnest, and the projections are for really strong earnings expectations of 18% growth this year on the back of double-digit last year. So there's some underpinnings underneath the market that should protect it as the Fed begins to raise the rates. And if they stay gradual and if they can take away those chairs very slowly, the music can play on a little bit longer.
Picking up, Jeff, on what Matt just said in terms of the valuations getting cheaper, shouldn't they get cheaper, though? I mean, aren't we in for a period of heightened volatility in terms of what the Fed might or might not do, what Washington might or might not do on the tariffs? And by the way, we've got a lot of performers in the market, like technology, which are up about 11% so far this year, Boeing up about 10% so far this year. I mean, shouldn't we sort of step back and reevaluate at this point?
Yeah, I mean, I think that's an important point, and the market has taken cues from inflation starting to come up from the rate move we saw in the beginning of the year to now. So I think it is natural that we're seeing that additional volatility, and I think it's important to put 2018 as far as what might be left in the tank in perspective. If you assume $155 per share for earnings, which is somewhat down the middle, and then you put an 18 times multiple on that, that only puts us to 2790 in the S&P 500. So really about 1% higher from where we are today. So that leaves you, if that's your total for the year, at about 6% total return. So not really all that exciting, especially considering we're already there. And if we just chop around for the rest of the year, that really might not feel so good. But at the end of the day, we do think that that's an issue, and you have to keep that in mind because if we're only up 6%, it might feel bad. But again, coming off of a 20% plus year last year, if we get another 6% total return year this year, it's really not the worst outcome.
We're going to have to leave it there, but we thank you both for joining us very much, Jeff Mills and Matt Roddy.